5 ways you can get your mortgage interest rate down today. Interest rates have been high for a couple of years now. They went up really fast. Lots of buyers on the sideline, right? Waiting for those rates to drop. Well, when rates finally do drop, a lot of buyers come off the sideline, buy the available inventory, and then what happens? Prices start going back up. So that savings that everybody was hoping for on a lower interest rate is lost because they're paying a higher price for the home, because less supply and high demand equals higher prices. So to avoid that and build equity today, these are strategies you can employ today to get a better rate. And if your rate is still a little bit on the high side, when rates come down, you can refinance. But let's dig into these 5 ways. Number 1, boost your credit score. Higher credit score, you've shown to lenders that you pay on time. So you have that history, and they're willing to lend you money, and they want to lend you money, and they're willing to give you a better rate for it. So if you can boost your credit score, do it. And if you don't know how to do it, personally, I would stay away from some of those credit repair agencies. I would talk to a good lender. A good one will give you a pathway on how to increase your credit score the most efficient way possible. Number 2, increase your down payment. As the expression goes, if you've got more skin in the game, the banks are gonna like when they see that, and they're gonna be willing to lend money to you and give you a preferred rate because they're banking on you, pun intended, banking, not wanting to lose that money that you put into that purchase. So they're gonna give you a preferred rate because you have skin in the game. Number 3, 15-year versus 30-year mortgage. All the news we see typically is about the 30-year rate. That is the most common mortgage. There's the 15-year rate. You're gonna pay as much as a point less. So if 30 years 7, 15-year might be 6%. You're paying less interest, right? Interest is you're paying somebody else's mortgage. You're paying somebody else's car note because you're paying them money back, right? Interest is money you're just spending away. So if you can lower your interest rate or lower the amount of time you're paying interest, like on a 15-year mortgage, right? You'll be paying less. Your monthly note will be higher, but you're paying less interest, and you're getting a lower interest rate today. Buy discount points. Number 4. So a discount point is a permanent buy down of your interest rate. Easiest way to explain it is through math. You're buying down your interest rate by 1 point. To buy down the interest rate, you're spending 1% of the loan. So back to math. $300,000 loan, you spend $3,000, 1%, to buy down your interest rate. However, that 1% buy down is not really a whole point. You're not going from 7% to 6%. You're buying down about a quarter or a half of a point. So instead of 7, it might be 6.75 or 6.5% for that $3,000. You can spend another $3,000 and get it even lower. So you can spend $6,000, buy it down 2 points, and maybe you get it to 6.5 or 6.25 or whatever the lender's offering you when you buy down a point. Just be careful, don't get tied up in the language there. It's a more expensive way to buy down your interest rate than the next example I'm going to show you, but this is permanent. Okay, so think of, you do it once, you fix it and forget it. The cost of that buy down is part of your closing cost when you close on the home. Number 5, I would consider the coolest and sexiest way, is the interest rate buy down. This is a temporary buy down. And what you're doing here is that you have an extra set of closing costs on top of your typical insurance, lender fees, title fees that buy down your rate. There's 2 main types. There's the 3-2-1 and the 2-1 buy down. Easiest way to explain would be the 2-1. You're buying down your interest rate 2 whole points over a period of 2 years. So the first year of your loan, you're buying it down, let's just say the current rate is 7%, you're buying it down to 5% for the first year. The second year, you're going to be paying 6% interest. So you're saving all that money on the monthly payments. The third year of your loan It's at whatever that original rate was that you were approved at, which is 7%. Let's just say 7% in this example. And it'll be 7% throughout the life of the loan. However, remember, it's an election year, right? And the forecast, the economic data is pointing that interest rates will start coming back down to some degree. So if you do a interest rate buy down, you may never pay that 7%. You may decide to refinance after year one, and maybe you get it at 6% for the next 30 years, or you get it at 6.25. Whatever that number is, you can refinance, and that's what people are using with these interest rate buy downs. If you do the refinance soon enough, that closing cost expense that you put up front when you got the interest rate buy down, you'll get some of that money back. It depends on when you refinance. The other thing you can do is ask the seller to pay for it as part of your closing costs, right? So you're kind of not having to write that huge check for closing costs for their typical closing costs and the interest rate buy down. Get with your lender on details on how to do a buy down, what the cost is, what the benefit is. Definitely talk with a qualified lender on that. But it's a great way. We've helped people with that this year, and it really truly is a savings. There's no doubt about it. So I hope that helps. What we say around here is you marry the house, you date the rate, all right? Prices are now probably as low as they're going to be in the foreseeable future. So you can always refinance later. If you like the content, please give it a thumbs up. If you like the channel, do subscribe. We appreciate it, and we'll see you next time. Bye-bye.
Hello, my name is Blake DeBott. I'm with Magnolia Home and Auto. Living in the Gulf South means we must always be prepared for the possibility of a hurricane arriving with little warning. To ensure you're ready in case a storm heads our way, here are a few essential tasks to be handled beforehand. Number 1, review your insurance policy. Double check that your policy is active and hasn't been canceled. Sometimes cancellation notices can get lost, leaving you without coverage. Confirm that your policy is in place and has been paid. Take the time to understand your coverages and deductibles, and don't hesitate to discuss any uncertainties with your agent. Number 2, gather important documents. If you have flood or homeowners insurance, make sure you have copies of the policy's declaration page. Be sure to take these documents with you if you have to evacuate. Number 3, keep contact information handy. Obtain direct contact numbers for your insurance carrier so you can file a claim if necessary. During a storm, power outages may make it difficult to reach your agent, so having the carrier's contact information on hand will help you start the claims process promptly. Number 4, document your belongings. Prior to a hurricane's arrival, take video and photos of your home and its contents. This documentation should include all interior furniture, electronics, clothing, and other valuables. Don't forget to capture the entire exterior of your home, including the roof's condition, as well as any detached structures. By completing these tasks in advance, you can better protect yourself and your property in case of a storm. Being prepared ensures a smoother claims process and gives you peace of mind during uncertain times. If you have any questions, don't hesitate to reach out via phone or email, and stay safe.